to talk about the question of can you have your cake and eat it too? And it's my hybrid approach to trading trends, trading for both short-term and longer-term trends. Before we get into that, there's the obligatory disclaimer screen. I could sum it up a lot quicker and just by saying that all predictions are about the future, and a lot of stuff can happen between now and I think Dan did a pretty good job of introducing me, so I'm not going to bore you with that. You can get a full bio on my website, davelander.com. If you can't sleep at night, you can read that. One thing that I do want to say is that I realize you're probably more interested about the methodology than you are in me. So just want to let you know that it's not my way or the highway. If you could take just a small piece of what I do and make what you already do successfully better, then I would be honored by that. So there's more than one way to trade the markets. In fact, that's what makes the market. So keep in mind that my way is not the only way. Just a few things real quick before we hop into it. There's no secrets or proprietary formulas. Everything that I do is fully disclosed. It's not a get-rich-quick scheme. There will be losses. I'll probably talk a little bit too much about the fact that there will be losses, but I want to temper everybody's expectations. If you do this properly, you're going to be pleasantly surprised longer term, but you will not get rich overnight. There'll be some great times where you print money, and there'll be some times where you just kind of chop around a little bit. But you win by surviving the bad times relatively unscathed, and then by doing fantastic in the good times. One thing I want to really point out here real quick is there's a repeatability in what I do. Not to beat up on the day traders, but if you're trying to follow a day trader, by the time you're getting in, he's getting out, and it's almost impossible to follow him. Even if they are successful, it's very difficult, and there's some other methods that are much more complex, and it's tough to follow them. But if I recommend a setup either directly or you study my methodology and you find it on your own, it should be pretty obvious where you should get in, where you should get out, where you should take profits, and there should be, again, a repeatability in that. And that's one of the big things. And I didn't really think that was that big of a deal until I did a few webinars a couple of years ago. And after the webinar, I got a few phone calls on that. So, again, it is repeatable. And I think it's simple and very teachable and learnable, provided, of course, you're willing to learn. And we'll get into that a little bit later on. I do prefer daily charts. I do prefer stocks. There's an inefficiency in stocks that doesn't occur in many other markets, but it does work in all markets, and it does work in all time frames. So it is repeatable in that it's also fractal within different time frames. You can look at a weekly chart, you can look at a monthly chart, you can look at a 1-minute chart or even a tick chart and see some of the same patterns unfold. I just prefer the daily. I think we're only wired to make so many decisions. And it's hard work, but it's a lot of fun. At least for me, it's like every day I get to go on a treasure hunt. I get a big cup of coffee and I just start going through charts. And I go through about 2,000 charts, maybe 3,000 charts every night. And for me, it's just a lot of fun because I know if I find that little inefficient stock that has the potential to go up 100, 200 or more %, I know I'm going to be rewarded greatly. And I also know that my clients are going to be very happy with me. The goal is to minimize losses and allow for home runs. I'm just going to touch upon money management briefly here in a few minutes, but the reality is you really need to study money management really hard, at least when you're starting out, not longer term. When you're just starting out, you really want to study money management as hard as you're studying the setups, okay? Now, the question is, why trend follow? Well, it's where the money is. So even if you are what is so-called a contra-trend player, you have to be a trend follower for at least some length of time. Otherwise, you would not get paid. So my feeling is, why not be a trend follower all the time? And here's the thing. All successful trades must capture a trend. So if you buy at point A and you sell at point B, from A to B, notice I have an arrow drawn in here, that is a trend. So sometimes when you get caught up plotting that 50th oscillator, just ask yourself, is the market going up or is the market going down? And all you have to do, I know, haha, very easy, right? But all you have to do is buy lower than you sell or sell short higher than you buy to cover. Now, my approach is a very simple one. And if you can understand this screen, then you understand my entire methodology. Just kidding. I believe that one should not increase beyond what is necessary the number of entities required to explain anything, and that's Occam's razor. I was in a webinar on Monday. I do this weekly show. I'm the host of a webinar for timing research where we get with market panelists to run there. And one of the things that came up was the fact that you could take a very complex proprietary system and you could probably boil it down to something really simple and non-proprietary, and I fully believe in that. And then Leonardo da Vinci said that simplicity is the ultimate sophistication. So here's the question. Should you trade for short-term and longer-term gains? And my feeling is trading is like predicting the weather. You can only look out so far. So if it's cloudy and thundering outside, and I'm looking out my window now, and it's starting to cloud up a little bit, so I bet we're going to see some rain within a day or so. But if it's cloudy and thundering, you know that there's a pretty good chance it's going to rain soon, but you don't know if it's going to be raining this time tomorrow or this time next week or next year. So it's very difficult to predict further out when it comes to markets, but you can predict the short term more accurately. Now, some of my clients have misunderstood when I say that, so I want to be perfectly clear. You can't predict the short term all of the time, but if you have a setup in place and now all the stars are aligning, I probably shouldn't say that because some people use astrology, and I just don't believe in that, obviously. But if everything is there, if you have the setup, you have some big picture classical technical analysis type of pattern, then you know that there's a pretty good chance, provided that setup is there and it triggers, that that market has a potential for a short-term move. Now, don't worry, I'm not going to get into statistics, and statistics are worthless. I think 75.3% of all people know that. But a probability cone is kind of a cool thing to play with if you want to see what happens with the market. And this looks back, I think in this case I have it looking back 50 days. It's a 50-day historical volatility, but don't worry about that. And it projects forward. Just know that the further you go out in time, the further that market has the potential to swing. So again, all predictions are about the future, and a lot of stuff can happen between now and then. So very difficult and almost nearly impossible to predict the long term when it comes to markets. When I did a lot of mechanical testing back in the mid-90s, I discovered that a long-term system, if you were programming long-term systems, you had about a 23% chance of getting it right. So you were wrong 70 to 80% of the time. So you're going to be wrong a lot if you're trying to predict the long term. So let's look at some of these things. When it comes to the market, only the short term can be predicted with any degree of accuracy. Again, all predictions are about the future, and a lot of stuff could happen between now and then. The great thing about shorter term trading is your risks are better defined because the market can only move so far within a short period of time, as a general statement. Unfortunately, you don't make enough because the market can only move a short period of time, a short amount, in a short period of time, as a general statement. The real money is in longer term trends. Trends take time to develop. And here's the bad thing. I kind of added this at the last minute because I thought it was important. Even if you're short-term trading, something bad can still happen. The so-called black swan can rear its ugly head. You could still lose a lot of money. Recently, like QLYS, I think yesterday uploaded, Twitter a few days before that. So bad things can still happen over a very short period of time. Now, longer-term trading is where the money is. Unfortunately, the longer the forecast, again, not to beat the dead horse, but the less accurate you will be. And your losses and your drawdowns are just too large. In addition to being highly inaccurate, as I just said, your drawdowns are going to be horrible. We all like to read about these famous traders, and I've got all the books here on my bookshelf, that have amassed all this money trend following, but what they fail to tell you is many of them have subsequently blown up. If you poke around the internet a little bit, you'll see what I mean. And the reason they've blown up is because the drawdowns can be abysmal. These big trends are, number one, nearly impossible to catch, okay? Although I will show you how in just a minute. But they're not nearly impossible, difficult to catch, okay? And then when you do catch them, you're going to have some pretty serious drawdowns because your stop placement is going to be extremely wide. Going back to that little parabola we plotted, okay, you can see how far that market can move. So your stop is going to have to be outside of that longer-term volatility. Otherwise, you'll have tremendous losses. So here's the question. Should you trade for short-term or longer-term gains? And the answer to that is yes. I believe you could have your cake and eat it too. So trade for that small gain, okay, and take a quick profit, but keep a portion of that position as long as it moves in your favor. Now, this is a little dated example, and one reason that it was dated is because it stayed open for nearly 3 years. But you can see we had a nice solid trend here, and I'm going to show you how to recognize the trends like this in just 1 second. And we got a nice little pullback, which is the crux of my methodology. And this stock ran for several years, as you can see. It had a pretty good run to it before eventually stopping out. I think it actually went on to even go much higher after that. Now, so how do you do this? Well, you want to change hats from being a trader to a trend follower, okay? Now remember, as I said, long-term trend following, very difficult, low in accuracy, and you're going to have really bad drawdowns. And if you're lucky, you won't blow up. But if you're trading for a short-term gain, in other words, a swing trade. I'm slotted as a swing trader. My first 2 books had the word swing trading in the title. But if you're trading for a short-term gain, looking to get in and then looking to get out quickly, and we take half profits here. I'll try to touch upon the money management a little bit. And then hang on to a piece of the trade, the other half, for hopefully a long, long, long time. Now, initially, we kind of stair-step that stop higher, almost on a one-for-one basis. Let's say the stock goes up $1. We're bringing that stop, that protective stop, up $1, okay? Now, once we get into this longer-term trend and things begin to materialize, we're able to slowly open up this stop, often by not doing anything. Let's say it goes up $1.35. Well, we leave our stop where it is, and then our stop increased by 35 cents, okay? And that's what I call, that's a little trick I call keep the change. And then we just slowly widen that stop out, and hopefully, and I hate to use the word hope in this game, but hopefully, when this stock corrects, you're able to ride that correction, and then it turns around, it goes right back up, and you're in that stock for a long, long time. When somebody says, hey, what's your holding period? I tell them, hopefully, at least 10 years or longer when I get into a stock. But obviously, the money management and the position management will take you out much sooner. So the idea, again, is to turn from that trader getting in on a short-term pattern into a trend follower, sticking with things longer term. And the way you do that, again, is with the trailing stop. And you notice that you just kind of let it widen out as the trend moves more and more in your favor. Here's another example. Solar stocks were on fire about 2 years ago, and they took off here. We got a short-term gain, and it didn't do a whole lot for a while, but we stay with it. And then you can see it just kind of worked its way higher and higher and higher. It didn't go straight up, but a nice widening stop allows you to stick with the position. Now, how do you predict the short term? Well, first of all, markets tend to vacillate between overbought and oversold. So if a market is oversold, it's due to bounce. If the market is overbought, it's due to sell off. Unfortunately, and this is why this is what's called mean reversion trading. Unfortunately, I'm not a big fan of mean reversion trading. And it's kind of like the proverbial dog on a leash. If he's walking down the sidewalk and he gets to one side, the leash gets a little tight, he kind of meanders over to the other side back and forth. So in theory, using that analogy, it works pretty good, right? Well, if you've ever traded for more than 1 day, you know it's the theory and the reality are 2 different things when it comes to trading. So in reality, is this market overshoots that overbought, sometimes stays overbought for a long time, or it overshoots the oversold, stays oversold for a long time. So there's a lot of problems with the overbought, oversold. Now, I kind of preach against the mean reversion trading because a lot of the mean reversion traders, they don't use stops. They say, well, if it's overbought, just keep selling it, and eventually it'll come back in. If it's oversold, just keep buying, and eventually it'll bounce up. Well, that'll work until it don't, okay? So be really careful if you're doing that. Now, someone said, Dave, you preach against mean reversion trading. And he was a mean reversion trader. Now, he uses stops. He's an engineer, very smart gentleman, and he's successful in mean reversion trading, but every now and then he gets stopped out, and so be it. And he's not taking those extreme risks. He might not make as much because he's using stops, but he's not going to blow up. So I shouldn't beat him up too much. But anyway, he was kind of giving me a hard time saying, he goes, you know, you are a mean reversion trader. You're trading reversion to the mean in the direction of the trend. And he's right. So what I'm doing is I'm looking for an uptrend, and I'm looking for an oversold condition. I'm looking to get on when that trend begins to resume and catch a mean reversion in the direction of the trend. In other words, I trade pullbacks, okay? So on the short side, you'd have a nice longer-term downtrend. You get a little pop from oversold back to overbought, and then you look to short as it swings back in the direction of the trend. And again, hopefully, you get that swing trade out from oversold to overbought, and then that proverbial dog breaks a leash, and you're able to ride out a longer-term trend. Now, this is what it looks like on a chart. And again, this is, I say fairly certain. You know you have a pretty good idea. If you got a pretty good trend, pretty solid trend, and the market pulls back, you know there's a pretty good chance you can get a little swing trade out. But you don't know if you're going to get a longer-term trade out of it, and that's where the money management comes in and the trailing of the stops. So this is my entire methodology in a nutshell, and this comes straight from the Layman's Guide to Trading Stocks. And it's pretty simple, okay? The rest is just details. We're looking for, first of all, a strong trend, which I'll show you how to recognize in a few minutes. We're looking for a pullback in that trend. And we're looking to enter if and only if this market begins to resume. If this market comes up a little bit and then comes back in, we avoid a losing trade. Very important concept, waiting for entries. I preach it almost every day in my column. In fact, I did it in today's column on my website, in the blog. Some people call it the blog, and also the newsletter. So again, you want to wait for that entry. If the market does rally up and hits the entry, then the first thing you do is you put a stop in, okay? Because no matter how great a trade looks, even if Big Dave Landry says, oh, I love this stock, it looks fantastic, guess what? I could be wrong, okay? So always use a protective stop when you trade. Now, if things begin to work in our favor, again, we take a little short-term swing trade profit, and then we get a trail of that stop higher. We get the stop up to break even once we have the initial profit target. And now, and I need to find a better way of saying this, but now we're playing with the market's money, so to speak. So if this thing keeps going up and we trail that stop higher, then the worst can happen, barring overnight gaps, is we get stopped out for a profit. So again, it all boils down to identifying trend or significant change in trend, and then entering that trend on a pullback. Money and position management or key. And then psychology. We're not going to have enough time to get into psychology, but psychology is vitally important. You must have the ability to execute and follow that plan. If we have time, I'll mention a few things that will help you to deal with the psychological issues of trading. Now, I want to talk briefly about what I call trend qualifiers, and these will help you to identify a trend. At point A, notice that this market is kind of doing that proverbial bouncing between overbought and oversold, at least somewhat, but it's going sideways, okay? Where was it here and where is it here? It's like, well, you draw a straight line, so there's no trend there. Now, I know you're probably thinking, duh, but you'd be surprised how many people send me charts that are going straight sideways and they want to get in, and I'm like, well, there's no trend. Why would you ever get in? Now, here we have a base breakout. Now, that's a positive development, but I would encourage you, unless you're trading an IPO, okay, that's one big caveat. IPOs, when they break out, they can work really, really well. And I spent a lot of time talking about that. If you poke around the website or if you look at my YouTube channel, I've got some really good videos on that, if I say so myself, on that. So you don't want to necessarily buy a base breakout in an established issue because more often than not, breakouts tend to fail, especially in more recent times, now that everybody and their brother has a computer on their desk and a little light goes off when the market breaks out. Now, some other things, once it breaks out, start looking at the bars. If you get these wide range bars, meaning that, let's say you have some small bars and then all of a sudden a price bar gets really big, you know there's some excitement coming into that market. You want to look for gaps. You also will look for strong closes. This means that the market closes up towards the top of the range. This means that people were buying it into the close on an intraday basis, or it means nobody wanted to sell it into the close. So in other words, in day trade speak, they wanted to take them home. So keep an eye on that. Strong closes, gaps, wide range bars, all of this in the direction of the trend. Notice at this point here, this is a dated example, but I love it because it kind of shows you everything on a compressed basis. Notice that it did gap higher here, which is a positive development, but it ran up, lost steam, and came right back in. Now, at this juncture, we don't know that the trend has ended, but notice that the next day it did a gap up, or technically what's called a lap up, and it began to sell off. But then it makes a wide range bar down, and notice that the close, I don't know if you can see it, but the close is, I'll highlight it for you, is very poorly here. So at this point, we think this market might be in trouble. We get another follow-through day to the downside. We get a very poor close, and then it pulls back a little bit. And this is the pattern I call a first thrust. This is the first chance to get in this market on the short side, and then the stock begins to implode, and it actually goes to zero, okay? Now, probably the easiest thing I could teach you, and one of your greatest takeaways today is going to be look for consistency in a market. And when we get to some live examples here, I'm going to show you this. But persistency is that a market tends to go up day after day after day. You could draw a trend line through the bars. Mathematically, this is equivalent to linear regression. But I don't like to make things complicated. I just like to draw a bar through as many bars as possible. Now, moving averages do have lag, but they can be useful. Keep in mind that all indicators have lag, so you always want to look at price first and foremost. But then view indicators as illustrators, because the indicator is going to show you what already happened in the market. People think, oh, my indicator is predictive. No, it's not. It's not predicting anything. It's showing you what happened in the market. It's showing you what happened in price. Now, based on that, some things may happen, okay? You may have a setup, or something may look like it's going to continue in the direction of the trend or bounce from that oversold condition. But the indicator does not necessarily predict anything. The indicator indicates what is already there. But keep in mind they all have lag because they are derivative of price. So in general, I prefer to eyeball the charts, but moving averages can sometimes help me or alert you, I should say, to a trend change. So there's two important concepts when it comes to moving averages. The first is slope, and the second is daylight. Now, let's take a look at what that looks like on an actual chart. First of all, daylight means the lows are greater than the moving averages. I wrote an article in 1995 for Stocks and Commodities. I'm showing my age here. And it was a simple little breakout system. You were looking for a couple of breakout bars above the moving average. Okay, it was a little trend following system. I don't know if I call it a breakout system. But anyway, you were looking for some lows above the moving average, and somebody called me up and said, you know, that's I like that concept of daylight, and so that term stuck. So you can see here's the low and here's the moving average. The other thing to look for is a slope. Is the moving average going up or is the moving average going down? And of course, always look at price first and foremost. Now, getting back to our prior example, we can see these moving averages just kind of going back and forth here, but notice at this particular point, daylight kicks in. Now, keep in mind that although moving averages have daylight, there is no lag at daylight because you're looking, it's a price-based pattern. So when that price jumps above the moving average, we're not necessarily looking at the moving average itself. We're looking at the price action above the moving average. So That's one way you could use an indicator without having to worry about the inherent lag of that indicator, okay? So in this particular case, these are what I call my bow tie moving averages. I'll show you those in a little bit more detail in a few minutes. And you can see that we have nice little daylight, nice little slope in these moving averages, and this market works its way higher. Also notice that we only have one little touch of the bar against the moving average during this entire trend. So just this little simple moving average would have kept you in that entire trend. Okay, and this is, again, this is just a simple average by itself. And notice we have a positive slope, we have daylight, and again, just one little touch, one little kiss of the moving average right there. In fact, you could actually trade that pattern as a pullback pattern. I think it put that in my latest book. Now, everything works better with trend, okay? If you're following a trend-following methodology and the market is trending, you're going to do really well. I know you're probably thinking, duh. It's kind of like you can't catch a tan if the sun isn't shining. So if the market's going mostly sideways, you might want to sit on your hands. But one thing that's kind of cool about the S&P 500 with this is the 200-day moving average. It's only had about 5 days of daylight, okay, in its last about 100% run, okay? So that's pretty impressive when you think about it. It's just a simple technique. Daylight, meaning the lows are greater than the moving average, has held for a significant amount of time. Now, we're probably going to test that pretty soon. This chart's about a week or two old, and the market's beginning to deteriorate a little bit. Now, above all, don't forget to draw your arrows. This literally is the back of my, or a scan, I should say, the back of my business card. That's what an uptrend should look like. That's what a downtrend should look like. And this one right here, never forget, sometimes the market just goes sideways. By the way, I get asked this often. The bull is not having his way with the bear and smiling about it. It just so happens that that's how the drawing came out when I hired a graphical artist. Anyway, I digress. There's three phases of trend. There's trend resumption, which is a generic pullback we've been talking about so far today. Then there's trend acceleration, and that's when you have a market that's gradually working its way higher, and then it begins to accelerate higher, and then again, you're looking to get in on a pullback. And then the third phase is the emerging trend pattern, and that's when you have a market that kind of bottoms out and then begins to rally off its lows and pulls back. I purposely drew this like a cup and handle because a lot of my patterns, such as first thrusts and bow ties, set up within these bigger picture patterns, such as the cup, which goes way back to Schaubacher and Edwards and McGee and all of those guys in classical technical analysis. And then in more modern times, it would be cup and handle, which is William O'Neill. So big fan of the cup and handle pattern, big fan of the cups patterns and all that classical technical analysis. What I like to do, though, is mix in my setups within those patterns. And I'll explain that in a little bit more detail in just a second or two. So here are some of my favorite patterns. Obviously, the generic pullback, which I've been talking about all day today. Trend knockout and persistent pullbacks. Let's take a look at those, especially the combination of those two combined. Now, instead of reading you the rules, let me just show you what it should look like on a chart. This is kind of blown up here, but this is a longer-term serious trend. And then this market has a wide range bar down. And notice that it takes out, in this case, 1, 2, 3, 4 lows. So it should take out at least 2 lows, meaning that this low should be less than at least 2 lows, but it should also be on an expansion of range, okay? Notice the size of these bars in here are like this big, okay? And then notice this bar is this big. Now, the idea behind this pattern, and it's one of the simplest, but it works so well, and it's one of my favorite patterns, is that when this market begins to sell off after it's making this brand new highs in here, it attracts some eager shorts, and it knocks out some nervous longs. Now, getting these people in and out of the market can help to propel the market higher, because if the market begins to rally, the shorts are going to be forced to cover, and all the people that were knocked out are going to be forced to either put up or shut up. In other words, buy back in. So that can really help your position out. So let's look at a couple of these. you can see this one's also very persistent in its trend. Notice that shorter term it worked its way higher, and then longer term it worked its way higher. And you could draw a bar through nearly every single chart. You could draw a line nearly through every single bar, and then it styles off sharply, okay? So you would look to get in above this high. Now, here's one that I actually put in my trading service. In fact, I would say nearly every chart in here has been a stock that I've recommended, and I'll explain that in a little bit more detail in a minute. But notice here you have a wide range bar down, and this is what it looks like blown up, okay? But at first you have a gradual trend, gradually working its way higher, and then this trend begins to accelerate higher. So that's that accelerating momentum strategy I kind of hinted about earlier. It's also a nice persistent move higher. Let me clean this chart up so you can see. See this little bar I drew in here? This little line, I should say. Little line through the bars, and you have a trend knockout. So you look to get in as that trend begins to resume. And this stock ran up about 200% from that entry. So it's better than a poke in the eye. Now, your persistent trend, you want to look for that persistent uptrend or downtrend. Ideally, you want 20 days, okay? Ideally. But sometimes you can get persistency over a short period of time, and it can be very, very useful. Even 4 and 5 days or 1 week or 2 weeks of persistency can be very, very useful when it comes to a market. So, again, notice that this market has worked its way higher in a very persistent fashion. As a general statement, it tends to go up day after day after day. You get a little bit of a pullback here, and then you get a really nice trend resumption. So that's a very easy pattern to recognize, and it's a very powerful pattern. And this is the one we were looking at just a second ago. Notice that this market also was accelerating higher. Okay, it was beginning to go a little parabolic. Now, it can really help you get in these parabolic moves. It could be a little scary at times because the market's going straight up, and then you get the knockout move, okay? But once you get this knockout move, it's shaking out quite a few people, and it's probably attracting some shorts. And again, this is what it looks like longer term. Now, those are my favorite ways to get on established trends, okay? But what about emerging trends? Well, if you sat around and you waited for a nice established trend, you would miss the crux of the move a lot of times in a lot of markets, okay? Right now, for instance, energies are bottoming out. Brazil is bottoming out. Greece, even, believe it or not, is kind of bottoming out. And all of these areas are setting up. Second-tier China stocks are bottoming out, and I'll show you a few of these in a minute. And some really nice trends are beginning to emerge. So again, your emerging trend patterns or your trend transitions, you wait for you don't try to buy the market down here, okay? Let's say this looked cheap to you, that it's cheap here, that it's cheap here, that it's cheap here. A lot of times, the market's in a downtrend. It's going to continue going down for a long, long time. Remember that trends last a lot longer and go a lot further than most people are willing to believe. So instead, what you do is you wait for the market to bottom out, and you wait for that rally off the lows. And then you're looking to get in at the first tiny little correction. Now, if we're trading a generic pullback, we're looking for something like that might look like that, okay? But when you're coming off the lows, notice that I purposely drew it in just a little bitty tiny blip down. You're looking to get in at a little tiny correction because the whole world is waiting for a deep correction, and that might not come. If it doesn't come, then they're going to be once again forced to put up or shut up. By the way, everything I do has some sort of psychological basis behind it. We're looking at a chart pattern that is reading the mind of the market. In other words, what have the participants done? What will they likely do? What is their psychology? How can we use that to our advantage? Now let's talk about the bow tie pattern. The bow tie pattern, it's a simple moving average pattern, and we're looking for the moving averages to kind of come together and get to spread out, and it kind of resembles a little bit of a bow tie. Now, here are the moving averages, 10 simple, 20 exponential, 30 exponential. I have a YouTube out there. If you go to my YouTube channel, which is www.youtube.com/c/Dave Landry. Okay, and you search my channel, there's about an hour video on bow ties that explain them in a lot more detail, and just to avoid too many questions about the indicators and why I chose them. But it's a 10 simple, 20 exponential, 30 exponential, and you're looking for them to cross over a short period of time, and again, kind of looks like a bow tie, okay, and then spread out again. Notice the 30 is above the 20, above the 10, and then vice versa over here. So that doesn't mean a whole lot, but let's look at a real chart, and you can see that they all kind of come together, ideally over a short period of time, and then they begin to spread out again. And again, that gives you the appearance of a bow tie. You wait for that market to have a 1 bar pullback at least, and look to enter, if and only if that trend shows signs of resuming. So here's one, and this was a little solar stock that ran up about 600%. Notice that it tried to kind of get its act together back here, but it didn't quite bow tie. Then it rolled right back over. And then the moving averages kind of meandered back and forth and back and forth and back and forth. And notice that it tested its all-time low. Now, this stock was up in the 40s or 50s or maybe even higher. Kind of fell from grace. It's what I call a phoenix stock, okay? It kind of rises from the ashes. And you're looking for, again, those bow tie moving averages come together over a short period of time. And you're looking to get in the first little pullback. So it's got a nice little pullback here. Those who are schooled in classical technical analysis, you'll see you've got a double bottom here. You also got a nice cup and handle. So when you see a market do this off of long-time lows, such as the energy stocks right now, second tier China, Brazil, and maybe now Greece, you know these markets have a lot of potential. This is TGA. This was a recommendation recently. Notice it sets up as a bow tie. It begins rallying nicely off the lows. Also, what do you have? You've got that nice kind of cup-looking pattern in here, okay? Multiple bottoms. So you don't buy because you think it's bottoming out. You let it bottom out, and you wait for some sort of signal that the tide may have turned before getting in, okay? Now, catching short-term and longer-term trends, you want to pick the best and leave the rest. And I'll touch upon stock selection in a few minutes here. You want to let things unfold. Sometimes things take time to develop. You want to stick with positions until proven right or wrong. So let me go back to this chart here. Notice you were up 12%, then you were up 0%, then you're up 25%, then you're up 4%, then 44%, 25%, 95%, 72%, 211%. A lot of people can't ride out these swings. Well, first of all, we're taking partial profits in here, so we reduced our share size. And once you're profitable, then you have to be willing to give up some of those open profits and stick with that trend longer term. As I preach, if you quit at 50%, you'll never make 100% in the market. If you quit at 100%, you'll never make 200%. If you quit at 200%, you'll never make 400%. I think you get the idea. But Dave, how many times do you make 400%? Well, not that often. But so what? If I quit at 400%, I'll never make 800%. So how much is enough? It's never enough. You're going to have losses on trades. So you're going to have to make as much money as you can when you catch a trend. You don't want to second guess it. You want to ride it out as long as you can. So let things unfold. And again, you want to loosen up those stops, and it's often by doing nothing, okay? As the position moves more and more in your favor. Often by not doing anything. I guess my wife would correct me on this slide. Here's something very important. We're not going to have enough time to get into psychology today, but I'll give you one little tidbit here to walk away with. You want to obsess before you get into a trade, not afterwards, okay? Plan your trade and trade your plan. So everything is known when a chart's at this point here, right? But this is the unknown. So you have a stop in place. And that's the only thing you have to do. Now, right here, you want to obsess. Okay, is the stock trending? Is it set up? Does it look good? Or are there any other stocks in the same sector that look fantastic? Is the overall market just chopping sideways? So you want to answer all these questions. And then you decide to get in if it triggers. And then there is nothing to do other than honor your stop and take partial profits if offered, okay? But that's it. But a lot of people, once they get to this point here, once they get into actual trade, oh, Dave, it went down a little bit today, and the market went up. I think that why are people selling when the market's going up? And then they worry and worry and worry. And if you're obsessing over a trade, you're going to forget about, or you're not going to be able to see the other opportunities that may present themselves. So get into the trade and just let it work. Now, let me just touch briefly on money management. When I say this quite often, I think I said it on Monday even when I was in the presentation. When I'm speaking, after I get done speaking, the stage is normally, I'd say, rush the stage. Well, at least a few people come up to the stage at least. And 9 out of 10 of them want to know about setups. And I love talking about setups, and that's why we just talked about setups the last 30 minutes or so, 45 minutes. But if somebody asks me a money management question, I know that that trader has either made it or is close to making it as a trader. Because money management is vital, and they're more concerned about not losing money as they are about making money. Setups are exciting. It's fun, okay? It's exciting. But the reality is you have to have a money management plan in place. So let me just give you a few things to take home. You want to risk only a small amount on any given trade, but be consistent, okay? If you're newer to trading, maybe 0.5% if stopped out at any position. Once you get more established, maybe about 2%. But you don't want to risk 2% and get stopped out, and then risk 0.5% and then have a winner, and then you can't switch it up, because as fate would have it, your big trades are going to be losers and your little trades are going to be winners. So you want to be consistent in that, okay? If you get stopped out, you get stopped out. One big winner will cover numerous losses, okay? So be it. You get stopped out, so what? I know, easier said than done. I drop an F-bomb, but then I scream next and move on. Now, you want to take partial profits, and that's half when your reward equals your initial risk. So let's say you're risking 5 points on a trade. When you're up 5 points, you want to take that half profit off. Now, some people are like, Dave, that's 1 for 1. Shouldn't it be like 3 for 1? No. On the first loaf, it should only be 1 for 1, the first half of the trade. The second, you want that to be 10 to 1, 20 to 1, 100 to 1, 1,000 to 1. You don't know what it's going to be, and you just ride that trend for hopefully a big long-term move. I have 2 YouTube videos out there somewhere under weekend charts on how this does not have, as system people would call it, a negative expectancy, okay? But again, it's not my way or highway. I think this works extremely well. I know this works extremely well. If the trend materializes, you're still in it, okay? If it doesn't materialize, at least you made a little bit of money by taking those partial profits. So sometimes people say, hey, Dave, is your money management psychological, or is your money management statistical? And my answer to that is yes. We live in this microwave society, and I don't want to let freshman psychology rear its ugly head, but we're all looking for this instant fulfillment and instant gratification. And if you do get into a trade, you do get rewarded quickly on it, then that kind of rewards you, your short-term needs, and it kind of excites you. But if you are still able to capture the longer-term trend, then that kind of makes you feel good as far as being right longer-term, and you also are going to make a lot more money longer-term. So not to get into Maslow's hierarchy of needs, but the short-term and the long-term aspects of trading can really help you climb that ladder, okay? Now, a good defense is crucial, but never forget that a good offense going in is your best defense. So let me just show you a few tips on picking stocks. You want to seek obvious trends or obvious emerging trends. You'd be surprised how many times I get charts from people saying, Dave, I'm thinking about this stock. I'm like, really? It looks like an electric cardiogram. Avoid stocks, what I call with bad memories. So if you've got let's see if we can do a blank screen here. If you've got a market, and by the way, I use the word market instead of saying stocks because it could be any market. Markets are markets. They're all humans behind them, right? But if you've got a market that's doing like this, let's say it goes down, and let's say it makes a beautiful little setup, but if you look back in time, there's a big wad of trading, okay? Guess what? The people that are still in the trade are going to look to get out at break even. Today in my column I wrote, I quoted Tom McClellan, a friend of mine. He says, I'm not name dropping, he just said some good things. This man is right. These people will screw you, but here's what you can do. Because you don't want to trade if you have this overhead supply. Because when you make a trade, as Tom said, you're not only forming a relationship with the company, you're also forming a relationship with everyone who has bought the stock prior to you. So, and those people will screw you. And they sell for a variety of reasons that have nothing to do with the company, the chart pattern, or whatever. But I will tell you this, overhead supply is something very important to watch out for, because that means that people have bought that stock in that range, and when they get back to break even, they might be looking to get out. They might be looking to get out. I had a neighbor call me a while back, hey Dave, want to buy some GE? And GE was about, I don't know, $18, $19 a share, and then between like 20 and 25 or whatever, it just had a big mound of overhead supply. And I said, I wouldn't buy it because it's going to rally up, and when it gets to about 20 to 25, it won't go any further than that because it looks like it's got a lot of what I call overhead supply. And he says, I bought it at 25. So it makes me realize that there are people behind those bars, okay? Look for classical technical analysis patterns, such as cup and handles, such as bow ties and things like that. But make sure you have some kind of trigger. In my case, I use a setup. That would be a bow tie or a pullback or a first thrust or something like that to get into it. And never forget about the power of persistency. Now, I've showed you a lot of longer-term examples. You're probably wondering, what have you done for me lately, Janet? Well, I'm going to show you. And by the way, I put a little black thing here just to avoid a wardrobe malfunction. Okay, this is the current portfolio as of a day or two ago. And let me just show you real quick what we've done and why we've done what we did. The white piece is where partial profits were taken, okay? And this is a hypothetical 100K, even though that trades are in real time, even though there's real trades in here, for educational purposes only and anything other disclaimer-wise, it's a hypothetical 100K account, okay? Just to comply with legal. We're looking for 1% on the first loaf and some big amount on the second loaf or the second half of the trade. So if we're risking 2K per trade, 2% per trade, we're looking to make that 1% profit and then hopefully some multiple thereof. So notice like in this one here, we took profits at about 1,000 and we got roughly $1,000, a little bit less left over, okay? Notice this one, we got lucky on this one, it gapped up, we got that partial profits out, and then so far so good with riding that trend out there. And hopefully this becomes a big multiple of that number. So again, you take the position and you divide it into two. You have a trending loaf and a trading loaf. Although you buy all the position at once, you want to look at it as two different pieces. You want to sell half at a 1% profit, and then you want to ride out that second half for hopefully something that becomes much bigger. Now sometimes you'll have a big number down here like 20K, okay? And then you'll have like one stock that's up 15K, and then you got some that are up and some that are down. Well, without that big winner, this number is going to be a heck of a lot smaller. Right now they're kind of evenly distributed, and that's usually not the case. Usually it's going to be a little bit more skewed where you're going to have a few big winners. So let me just show you some of these setups real quick, and then we'll open it up for questions. This is a steel stock. I think it's a South American steel stock. As I said earlier, South American stocks, steel stocks, energies, second-tier China stocks are all looking pretty good. They've all bottomed out. You've got a nice source of bottom working here. You've got a pattern I call a first thrust off of lows, and then you also have the bow tie and then the pullback. And that one was in the portfolio, and that's where we got in based on that pattern, and it's trading nicely higher. Now, here's another one, and here's a case of a nice persistent move higher. That's a persistent pullback, nice little pullback. And again, so far so good on that one. Here's a TGA we were just talking about. What do we have? Well, you got a cup. You got a nice thrust off of lows, what I call a first thrust. You got a little bit of a pullback and a bow tie, okay? These are all open trades at this moment. CTLT just stopped out, but before it stopped, it actually stopped out right before the presentation. Before it did, though, notice that it accelerated higher. It pulled back, and it took off. We got stopped out, so what? Guess what? It worked out. Now, it doesn't always work, but in this case it did, and net, you made money, so that's a good thing. NVRO, nice trend higher, nice little pullback. Also an IPO. IPOs have been on fire as of late. I just did a YouTube on that recently, and you can get that off my website. And then here's a second-tier China stock. Notice that it came down here. We didn't want to buy it because it was low, but we decided to buy it when it began to thrust off those lows and then pull back. Again, cup and handle, bow tie, all of those patterns are playing out there. You have another one. This is a South American stock. A little bit harder to see because we've kind of got it zoomed in, zoomed out, I'm sorry, a little bit. But you can see it did bow tie it here. It does have a one little bar pullback. And so far, we've had a pretty good run higher. Now, this is a short. Now, this one's not as clean. This is UAL. This is the big, thick company, a little bit more efficient type of company as opposed to some of those lower level, more inefficient issues. But notice that it did go sideways for a while, and now it begins to sell off, and its first little pullback in here, and that's what we're looking to trade. Kind of an inverted cup and handle, just the opposite of what we're looking at everywhere else. Now, also notice we just talked about overhead supply. Look at how much overhead supply is here. So this is a short, meaning that we want it to go down, obviously. So far so good. It's beginning to work a little bit. The good news is if it does begin to rally, I think the gains are going to be capped by that overhead supply. So this gives you an idea of what we've been looking at. I'm not a big fan of trading ETFs, but every now and then one will present itself as an opportunity. And this is USO, which is oil. Notice that we got a nice little double bottom. We got a bow tie here, and we got a little bit of a pullback from that, okay? We certainly don't want to buy on its way down because we don't know how low it can go. But once we see it bottom out a little bit and get a setup, it's worth a shot, okay? For those of you who have good eyes and recognize everything I've been saying today, notice you had a bow tie down. What happened from there? Nice little trend lower, okay? And then finally, this one's not working yet, but this is okay. We'll see what happens. You got a nice big cup and handle, a little bit of a pullback. You also have a bow tie. Now, people who are just joining me will probably say, Dave, in fact, I actually got emails. Dave, you just trade bow ties and these emerging trend patterns. And the answer is no. I do trade longer-term, more established trends too. For instance, something that looks like that and something that looks like that. It's just that in more recent times, the opportunities are in these stocks at lower levels, okay? So that's why you're seeing so many of those. Now, whenever I do a presentation, I always like to use live examples. So maybe MarketFest will have me back next year, and we can come back and look at all these live examples and see what worked and see what didn't. So what else is there? Well, there's a little more details, obviously, to the methodology, and there's a few more patterns in addition to bow ties that I like to trade. Stock selection is vitally important. I spent 14 hours in a course on just that. A lot of things I talked about today are in that course, or everything I talked about today in the course, but there's a little bit more to it than that. Experience is going to help you out a lot, too. I look at 2,000 charts a day. If you do that every day for a while, you're going to get better and better. I did the math. I think I've looked at over 10 million charts in my career. It's something I enjoy doing, okay? And I just think it's a wonderful thing. It's fun to be on a treasure hunt. Discretion can help out a little bit. There are some discretionary techniques. For instance, let's say you're at a stock and the stop is at $10, and the stock comes down and it hits like $10, and then it begins to rally immediately. Then stay with the position. I call it a stop, Nick. But there's some very little tiny things you could do that aren't very difficult that can really help you to become a better trader and to stick with more winners. Obviously, money management is important. The stop nicks, which I just mentioned, is pretty important too. And then your mind, the psychology is you having the ability to follow and execute your plan. Make decisions and live with them. This is hard for many. Making decisions is easy. Living with them is not. Okay. Okay. Couple things, and then I guess we'll go ahead and open it up for questions. I do have a store. This is my store, davelandry.com/store, or you can go to my website and click on products. If you like what you heard today, I have a special offer just for you guys here at MarketFest. You can get 1 month to my core trading service, which I just showed you the portfolio from, for $7, and it's normally $197 a year or $124 a month if you pay annually on that. You will have full access to everything in the service, including the open spreadsheet, a daily video, recommendations, actionable items, what I think about the market, and then money and position management. And if you need help, I give all my clients precedent access to me. I do answer my own phones. Obviously, you heard it ring a little bit during the presentation. I don't answer them during the presentations, but any other time I'll be happy to do them. And so if you're interested in this, just go to this tiny URL down here. It's tinyurl.com, WINVESTING. Okay? All right, I'm ready for questions. If you guys have any questions, let me see if I could read them. Dan, do you want to ask the questions, or you want me to just look at the question box and answer them?
If you can see the question box, go ahead and take it away.
All right, fantastic. What was my great breakthrough success in successful trading? Probably in part, or a big part, was that I was programming all this mechanical systems, that I was on this big holy grail hunt. And I'd go home every night and tell my wife about the latest and greatest system, and she would listen to me, and she would say, nod her head, and that's nice and everything. And then one day she said, well, how many systems do you really need? And it kind of hit me. You only need one system, and you want to keep it simple. And I think that was a big epiphany for me. And I began stripping away. Like, my chart looked like the first chart I showed with all those indicators. I began stripping away all those indicators, and then all I was left with was this chart. And now I'd say 99% of the time I'm just looking at a blank chart, and then I throw the moving average in every now and then, especially now that we're seeing these emerging trends. So that's probably the biggest thing. Being able to hook up with some old school traders early on helped me a lot. It gave me confidence in what I'm doing. It also taught me how to read charts, and a lot of things I'm showing you today were things that they showed me. No, I do not use any other indicators other than moving average. I use historical volatility, but only to tell me how volatile the stock is. Okay? So when I'm doing my sorts, and I'll give you this, if you have telecharts, I'll give you my scans, my exact scans. All I do is I sort everything by historical volatility, and then I look at a simple pullback scan. So that just shows me the most volatile pullbacks first. That's the only scanning and only indicators that I use, that along with the occasional moving average. For the most part, though, I just create a tradable universe of stocks that are 250,000 shares or more on average volume, 30-day volume or 50-day, whatever one you want to use, and I look at nearly all of those, at least the most volatile ones in that group, every single day, and that's before I actually run the scan. Yeah, the question is the market to roll over? Well, one day at a time. We'll know it when we see it. Every correction so far since 2009, the market has rallied out of that correction, but now it's beginning to look a little iffy out there. We're beginning to see some of these bow ties off of major highs. There's not enough time to jump in the charts today, but if you guys want to come tomorrow, I am doing a webinar tomorrow, and you go to davelandry.com and sign up. and I will be covering the situation in the market, the developing situation with the market possibly rolling over. Okay. Came late. Didn't hear earlier part of. Are you doing swing trade or day trading? I'm not doing day trading. I'm doing swing trading. I like to call it swing to intermediate. Okay. So I'm getting to that swing trade, and I'm sticking around as long as the trend moves in my favor. Okay, Bill's asking, what's the website? Thank you, Bill. www.davelandry.com, and then this little tiny arrow here if you're interested in starting the service is $7. And then once you get in, you could. What I would recommend you do, just maximize, even if you don't stick around, maximize your use of your $7. Go back and look at the last, as many as you can stand, 10 years of archives of every service that I've ever put out there to get a feel for the market. You could actually see my daily lessons that I put out, daily actionable items, and so on and so forth. So go out and do that, okay? Are you holding live daily trading? I recommend things live each day. I don't, and every now and then I'll put out a tweet, but for the most part, I do not, I'm not talking about trading all day long, okay, because I am a position trader. Do you recommend to stay on the sidelines till the market is clear? Well, Sherry, lately we've been lucky in that we've saw some opportunities in Latin America and all those other places we saw recently, so we're long those. Okay, Bill's got a good question. He says, why do you trade stocks over futures of Forex? I actually took that slide out because there's wasn't enough time to get into it, but I'll get into it since we have a few minutes. You want to look for inefficient markets. Inefficient markets can make much, much bigger moves than efficient ones, okay? A little biotech, a little solar company, an IPO can double or triple over a short period of time, but a Forex pair or an indice or a commodity is not going to have that same sort of move. I was a commodity trading advisor for 14 years, so I know efficient markets and I know inefficient markets. You're much better off in an inefficient market. Now, with that said, if you pick your spots carefully, and again, now I wish I would have taken them out. I had a couple of Forex charts that I took out. If you pick your spots carefully and trade something like only bow ties off of major lows or only bow ties off of major highs, you'll do really well trading Forex. But you're going to sit on your hands a lot, and a lot of people are more excited about about trading every day. They're more excited about the excitement than trying to make money. What account size? As big as possible. You could start with a fairly small account size, but the smaller the account, the more likely it will be tuition. You're going to end up with some frictional costs. Your commissions and such are going to be proportionally higher on a smaller account. You can start with a very small account, though. Here's the thing. I've never met an unsuccessful paper trader. So do learn and do paper trade and do study my methodology or someone else's methodology. Again, not my way, the highway. But realize until you put actual money on the line, you're not going to deal with all those psychological issues that you would have. I mean, ideally, you want at least a 100K account, but you could trade with something much, much smaller, especially to get started. What about options? Richard wants to know, what about options? Richard, options you have to get direction correct, and you also have to get price correct. I was involved with a hedge fund for about 15 years that traded options exclusively. So I do know a little bit about options, and I know that I don't want to trade them that often, okay? Every now and then you could buy an option as a substitution for stock, maybe an in-the-money option, but notice some of those positions that I just showed you, even though they went up 200%, a lot of them went a little sideways in that trend. So during that sideways movement, you would end up with a lot of decay, and you might actually have lost money. So you might have been right, but lost money, and there's nothing worse than that, okay? So tread lightly on options, okay? Do you have a specific, easy for me to say, okay. Maria wants to know, do you have a specific time to release your recommendations? Yes. Usually, lately it's been a little bit later because I've been kind of busy with some other projects, but usually I'll publish my recommendations about 2 hours to 3 hours after the close, okay? Thank you, Stu. Stu says, great, very balanced presentation. Glad to have you. Okay, Biff's saying how much then? You know, it depends. I mean, if you want the more, the better. I mean, if you had 50 to 100K, that would be ideal. You know, maybe 20K would be a good starting point, at least to get a feel for things. And then when you get less than 20K, you need to start thinking about that being a little bit more tuition, and it's gonna be hard to get your money management correct. Okay. Yeah, I only trade most. Yeah, every day. Yeah, I only trade daily charts, and even if I do, I very rarely will fire off a day trade. If I do, it's probably going to be off a daily chart pattern, like an opening gap reversal. Okay. What do you? Jay says, what do you use to look at 2,000 charts a day? I use telechart because it's sort of, I hate to use the word quick and dirty, but it's quick and dirty in that I could just bang on that space bar, and every time I hit the space bar, the chart changes once I set up my watch list. I literally used to go through one keyboard a month, and you know, my wife would be like, where are you going? I'm like, oh, I'm going to get another keyboard. She goes, already? And I found in storage several years ago an old compact keyboard, sometimes listen, it weighs about 10 pounds, and I have beat the crap out of this keyboard, and it just keeps on ticking. So that's, luckily I found that in storage because I didn't have time to run out and buy a new one. Okay. Maria wants to know, does this work for lower than 20K? Well, okay, the patterns and the setups work across all markets, across all time frames. So figure out what you need to trade, okay? And the patterns are there. So you can't, what am I trying to say here as far as the money is concerned? Ideally, you want as much as possible. You could start with a much smaller account, but just be really careful as far as, you know, make sure you're prudent with your money management and realize that it's going to be a little tougher, okay? I give anywhere from zero, Bill says, how many recommendations do I give a day? I give anywhere from 0 to, I'd say, probably usually a maximum of maybe 3 a day. 0, when the market, like, let's say the market stays choppy like it's been, and we don't see any of these emerging trends developing like we have been lately, then I might not actually recommend anything. Somebody quit a while back, says, oh, I said, well, why'd you quit? He says, well, it's not enough action. And it's like, well, you want to make money, or are you trading for action or excitement, okay? And then soon after he quit, what happened? Bam, that portfolio you see now, he quit last September. That's since about last November or so. Those stocks were all put into that portfolio over time. And then you saw how the portfolio did. We got stopped out of one. I think there was one we got stopped out of the profit that wasn't in there, and one that was stopped out at a loss. But the rest of them just did fantastic. And how do we do that? It's like the diet industry. Results not typical, all right? Let me throw out some little warnings and disclaimers, but certainly possible. How do we do that? We sat on our hands, and we waited for an opportunity to present itself. We waited for those opportunities. Do you give, Bill wants to know, do you give specific entry and, yes, specific entry and initial profit targets? Absolutely. Well, in fact, I don't have the live trades for today in that spreadsheet, but that spreadsheet is the actual spreadsheet that I published every day. Let me see if we can find it real quick. Okay, yes. Do you have, Chris wants to know, do you have tutorial videos that we can watch to learn your website? Yes, go on to education on my website. Also, I have over 1,200 YouTube videos out there. Some of those are just the market in a minute, which I think there's a little bit of education in that every day. And then the other ones are a little bit longer. This is the actual portfolio, so you can see if you come up to here where you see the entry and the price and everything. I don't know when pin's not working. Let's see if I can find it. Uh-oh, did I just connect? Oh, here we go. Okay. So you can see the entry, and then there's like the initial profit target, and then there's the stop. So all of that, including the maintenance of the position. See right here, I've got raise stop. So I put that out every day. Like a friend of mine said, it's pretty easy to talk about the markets and talk about patterns. It's a lot harder to pick stocks and show people exactly what to get and exactly how to manage the position. But I'm up for the challenge, and I've been doing this for over a decade publicly. Can I get more than 1 month at $7 if I order now? No.
Dave, can you talk a little bit more about your core trading service? It seems like for that 30-day trial for $7, they're getting a ton of value. Can you go over that in more detail?
Okay. Yeah. What I do each night is after I go through those 2,000 stocks and I go through all of those charts, I talk about where I'm seeing opportunities. I give a list of a small watch list, which I call the Landry list. And then from that watch list, I pick which stocks I like the best and I think have the most opportunities. And all of that is put into a video. And then the spreadsheet that you just saw is the actual spreadsheet. And I show the open positions, what's working, what's not, obviously, is all in there plain to see. And then, again, the specific recommendations are going to be right underneath that spreadsheet in the video. And then obviously I want to also cover the overall market, and then I also spend a little time showing the sectors. And then when it's applicable, like right now, bonds are imploding. That means rates are going up. Right now, the dollar is going down. That means commodities are going to be buoyed up. So when it's applicable, I'm going to show commodities and Forex and other areas that may be affecting the market, including areas such as gold too. Okay. Peter says, excellent, well presented, and lots of very useful info. Many thanks, Pete. Oh, you're welcome. Thank you. If one misses a day, can we watch a video of your presentation? I don't know. Dan, will these be recorded? Or are you talking about the, in a trading service? Yeah, I archive every day of the service. You can go back and watch the last 15 years. And I have older ones that aren't behind the firewall, and the newer ones are all behind the firewall. But yeah, you could certainly go back and do that. Yeah, the question, Michelangelo wants to know, can you trade these strategies with options? Yes, you can, but unfortunately, like I said earlier, you have to get the timing right, and you also have to get the direction right over the short period of time, so I'd be careful with that. Okay, looks like my time is up. Dan, do you want to take things back over? I want to thank everybody for coming, too, by the way.